administration sources. Greg?
Well, platinum was fixed this morning at $432.50 an ounce, up sharply from yesterday's afternoon setting of $426, but below earlier highs of around $436.75. Now, platinum group metals are at the highest prices since 1981, and on the gold futures market, February was quoted around $461 shortly after the fix in a volume of 129 lots. Taking a look at the Wall Street stocks right now, the Dow Jones 30 Industrials stand at 1,049.29. On the day, that is plus 4.41. The advancing issues are 964, while the declines are 364. The volume, 33.9 million shares traded today, and the tick is up 257. Transportation issues are up 4.05, while the utility stocks are slightly up 0.92. The ticker tape is running on time, and of course we have our usual 15-minute delay that you see on the ticker tape at the bottom of your screen. Well, right now we have a guest in our studio, and Susan is talking with him.
My guest is Gary Bosley of Dean Witter Reynolds in Hayward, and we're going to be talking about interest rates in 1983. Good to have you on the show this morning, Gary.
Good morning, Susan.
Gary, you want to talk about forecasting interest rates for the coming year. I've got to ask you, aren't there enough predictions already?
Well, that's a fair question, Susan, and certainly there are a lot of predictions out there. Every newspaper, every business magazine, and all the various pundits have their own forecasts of interest rates. But I think it would be interesting if we were to sometime go back to the forecast for January of 1980 to see what they said about what would happen in 1980, or what would happen in 1981, or even all the way back to 1985. Because to come out with a figure doesn't really do too much unless you know why that figure comes about.
Well, exactly where do you fit in here now, Gary?
Well, I fit in here, Susan, with trying to give the viewers a way to do this themselves as far as tracking these things. Because to come out and say that interest rates, short-term interest rates, U.S. T-bills or commercial paper, should be at, say, 8% for 1983, I think that doesn't mean too much. Because if they're at 10% on the high and 6% on the low, that doesn't help the person that locks in that 6%.
Well, Gary, in view of the forecasted unprecedentedly large deficit, foreign debts, possibility of default, trade wars, are you saying can anybody really forecast?
Yes, I think. Well, forecasting and tracking are probably two different things. And this is what I thought was the most important, is for the people to be able to track and see, in fact, where the pressures are. So if we know where the pressures are, then we can watch the interest rates.
Okay, let me ask you two things now, Gary. Tell us what to look for, and then I'm going to ask you what you see from looking at your methods.
Okay, well, first off, as far as what to look for, probably the most important two things are the yield curve and a commodity price index.
Okay.
So the yield curve is defined as the difference between long-term free market interest rates, which we'll use AAA corporate bond rates, so that's an interest rate, that's a long-term interest rate, and the difference between those and short-term interest rates, which are, or what we would use for our methods, as short-term commercial paper, 3 to 6 months. Now, these figures come out of the Federal Reserve Bank issues of St. Louis. So if we were to track this yield curve, is what we call it, if we track this throughout the history of the U.S., we can see what the pressures are. And we can see that the historical norm is that the long-term rates are normally over short-term rates by a fair percentage. And so we know, therefore, that if the short-term rates ever get over long-term rates, we've got very severe problems.
What about now the commodity price index?
Okay, the commodity price index is one that a lot of people don't usually think in terms of when they're looking at interest rates, and yet the tremendous roller coaster that we had in 1980 was called perfectly by a change in trend in the commodity price indexes. The Bureau of Labor Statistics used to put out their basic commodity index, and the Commodity Research Bureau still does use their formula. And by using that index in 1980, a person could have caught most of the moves of the unbelievable roller coaster, historically unprecedented, that we had in 1980. So if we watch the trend of a commodity index, we will then know what the pressure is on interest rates.
Is there anything else you'll be looking at?
Well, yeah. As far as what the person should be looking at and what I follow is the underlying state of the economy. Now, we can't look at the underlying state of the economy on a monthly basis or on a 6-month basis or take somebody's forecast for gross national product on an annual. We've got to look at it weekly. And to do that, we would use the U.S. News and World Report Economic Activity Index. That peaked out in 1974 at 127.2. It bottomed out in the recession of 1974-75 at 104.2, I think it was. The lows that we are still coming out of have been 93. This is where 1967 equals 100. So we can see what the economic pressure is and what the economic cycle is.
Gary, what are you seeing from using your methods now?
What I'm seeing from using the methods at this particular point is that the pressure is still off. My talk that I did here just exactly 1 year ago as we were looking into 1982 saw pretty much the same thing. The pressure was not there. So rates had to come down in 1982, and we're at the point now where they should be going sideways because there isn't that much pressure. But two things bear on this, Susan. The first thing is that if we look and do a cycle, a very simplistic cycle count from the interest rate peaks of 74, 75, and we count forward to X number of weeks, we can see then by doing the same thing from the peaks in 1980, where we're at now on that previous cycle, and they've been tracking extraordinarily close. It took 125 weeks from the interest rate peak in 74 to get out to the bottom of the run of the rates in 76, 77. We are now at week 105 and from the interest rate peaks in 1980, and I would use these as sort of a macro peak. And so if we did this count forward, we can see that things ought to go fairly steady for the next couple months. But the kicker,
Okay.
and what people should be watching along with that yield curve that I talked about is what I call the micro yield curve. In fact, when I was doing a regular phone-in here about 6 months ago on the program, this micro yield curve alerted anybody that was listening to me and alerted me as I was watching it that we were going to have that very, very sharp interest rate fall, because we saw the difference between rates in the commercial paper and bankers' acceptances and CDs as listed in the Wall Street Journal. We saw those rates changing, that micro yield curve changing precipitously.
Gary, one more time now. How do you put all these indexes together?
Well, what we do, Susan, is we look at the cycle, and we try to see where we're at on the cycle, and then we try to see where we're at as far as where the pressures are. And that pressure then comes from the trend of commodity prices as indicated by the index. Right now, that index continues to fall. This didn't happen back then. At week 125, we were having a rising index. Well, now the pressure is still off. Okay, we look at the yield curve, and right now the pressure is still off on the normal yield curve that we watch, but on the micro yield curve that tells us that we're having some interesting and significant changes, so we could be in for a short-term rise.
You know, Gary, you mentioned that our viewers should be following these indexes. Now, how do our viewers get these numbers?
Okay, that's fair. They get these numbers from the bank, St. Louis Federal Reserve Bank, and it's real easy to get their address. I can give it to them. And then they can get the numbers out of the Wall Street Journal.
Why doesn't everybody do this?
Well, that's fair also. They try and use simple numbers and take a shortcut, I guess. The weekly stuff is the only way to go. And it's the only way to find where the pressures are, and you'll see that most economists don't use them. And that if a person did watch them, they would keep them in track. They'd see where these pressures are right now.
Okay, Gary, are you offering something to our viewers this
Two
morning?
things, Susan. One is a graph of M2 that I clipped out of the St. Louis Fed material from 5 years ago and then spliced onto the one this time, showing that when the economy gets back to full steam, that inflation is going to get much worse than it has been in the past, because there's been virtually no change in Federal Reserve policy as shown by the results in the past years. And then the second thing that they want is a chart showing how to put together these interest rate pressure indexes.
A pleasure talking with you, Gary. Thank you.
Thanks, Susan.
My guest, Gary Bosley of Dean Witter Reynolds in Hayward. And for your copy of the literature Gary is making available this morning, call our investor hotline. That's 341-7721. Let's go back to Greg now and pick up some more news.
Well,